You switched jobs in your early 50s, maybe twice, chasing a higher salary so you could finally start putting real money away for retirement. Smart move, right? You maxed your catch-up contributions, your employer matched a chunk of it, and you figured you were making up for lost time. But there's a number I want you to sit with: 1.8 million. That's how many workers, according to a Yale Law Journal study, forfeited their employer match in a single year because they left before the vesting clock ran out. The total? About $1.50 billion, most of it absorbed right back into employer coffers, not redistributed, not returned, gone. And the workers most likely to be in that group aren't careless young people job hopping every 18 months. They're late starters in their 50s, doing exactly what every financial article tells them to do: maximize contributions, boost your salary, play catch-up aggressively. The vesting schedule is the part nobody warned them about. And with 3 separate catch-up limits taking effect in 2026, the stakes just got higher. The right move is to understand exactly what's at risk before you sign your next offer letter, not after. Let me walk you through how the 2026 catch-up tiers actually work, because the IRS didn't keep it simple this year. The base 2026 employee deferral limit for a 401k is $24,500. That's up from $23,500 in 2025 per IRS announcement IR 2025-1011. If you're 50 or older, you get a standard catch-up on top of that, $8,000. So your total employee contribution ceiling is $32,500. That's meaningful, but it's the second tier where Secure 2.0 gets interesting. If you're 60, 61, 62, or 63, and only those 4 ages, you qualify for what the IRS calls a super catch-up, which replaces the standard $8,000 with $11,250. That makes your total employee deferral $35,750. Age 64? Back to $8,000. Age 59? Same. The super catch-up window is 4 years wide, and then it closes. Now, the third tier. Starting January 1st, 2026, if you're 50 or older and you earned more than $150,000 in FICA wages in the prior year, meaning 2025 wages for the 2026 rule, all of your catch-up contributions must go into a Roth account, not a traditional pre-tax one. Charles Schwab's Learning Center has a clear explainer on this if you want the fine print. The practical effect is that higher earners lose the immediate tax deduction on the catch-up portion. That's not necessarily a disaster. Roth growth is tax-free, and for someone who expects to be in a similar or higher bracket in retirement, it might actually be better. But it does change the cash flow math in the year you contribute, and if your plan doesn't offer a Roth 401k option, your plan administrator has some catching up of their own to do. One thing worth knowing: the IRS published Final Secure 2.0 regulations on September 16, 2025. The formal compliance date is 2027. But the IRS expects plans to make a good faith effort to comply as each provision's effective date arrives. So if your HR department is telling you they haven't figured out the Roth catch-up yet, they're not technically in violation today, but they will be soon. Now here's where we get to the part that I think is genuinely underappreciated, even by people who consider themselves financially literate. Under federal law, specifically IRC Section 411A1, your own elective deferrals, including every dollar of catch-up you contribute yourself, are 100% vested immediately. Always. The IRS is explicit on this. Nobody can take your own contributions away from you, regardless of how long you've been with the employer. That part is safe. The employer match is a different story entirely. The IRS permits 2 vesting structures for employer matching contributions: a 3-year cliff schedule, where you own 0% of the match until year 3 and then 100% all at once, or a 6-year graded schedule where you earn 20% per year starting in year 2 and reach full vesting at year 6. Those are the legal maximums under ERISA, IRC Section 411A2B. Employers can be more generous, some are. But according to Vanguard's February 2025 research note, only 63% of Vanguard-administered plans offered immediate eligibility for employer contributions in 2023, and roughly half of all plans use some form of cliff or graded vesting rather than immediate vesting on the match. Which means, statistically, there's about a coin flip chance your employer's match has strings attached. And the combined 401k limit, Section 415 ceiling, that includes both your contributions and your employer's, is $72,000 in 2026. That number gets cited a lot in financial media as if it's all yours. It's not until you're vested. Let me make this concrete. Say you're 55, earning $100,000 a year, and you just started a new job with a 3-year cliff vesting schedule. Vanguard's How America Saves Data puts the median employer match at a record 4.7% of pay in 2025. On your salary, that's roughly $4,700 a year in employer match. Over 2 years, you've accumulated about $9,400 in employer contributions sitting in your account. You can see it on your statement. But if you leave at the 2-year mark, maybe another opportunity comes along, maybe the job isn't what you hoped, you walk away with zero of that $9,400 under a 3-year cliff plan. Your own contributions, every penny. The match? Gone. Now extend that out. If you're in the super catch-up window, age 60, 61, 62, or 63, and your employer matches a percentage of total deferrals including catch-up, the match dollar amount grows. That $4,700 average assumes a standard contribution rate. Employers who match on a flat percentage of compensation may not match on the catch-up at all, depending on plan design. But employers who match on actual dollar contributions can see those numbers climb. Either way, the vesting clock doesn't care whether those dollars came from a catch-up or a regular deferral. The clock starts when you join the plan. Here's a scenario that trips people up more than any other. I'd call it the salary jump trap. You're 58. You've been with your employer for 2 years. You're 14 months away from hitting 3-year cliff vesting on a growing match balance. A recruiter calls. The new salary is $18,000 higher. The math on the salary increase looks obvious. But if the new employer also has a 3-year cliff, you've just reset the vesting clock and you're forfeiting whatever unvested match you had at the old job. Plus, you start at zero again. On a $4,700 annual match, leaving 14 months early on a cliff plan costs you the entire 2 years of accumulated match. Call it $9,400. And then you spend another 36 months at the new job before you're protected. That's potentially 3+ years of $4,700 in annual match at risk during the transition window. The $18,000 salary increase sounds like a win. The full picture is messier. And here's what the Yale Law Journal study found that really bothered me when I read it. In the majority of plans they examined, those forfeited dollars don't go to other employees. They're used to reduce the employer's future contribution obligations. The employer literally saves money when you leave early. I don't think most workers understand that. The money disappears from your account and reduces what the company has to write a check for next year. That's a feature of the system, not a bug. Now, I said roughly half of plans use some vesting schedule, but there's a meaningful exception worth knowing. Safe Harbor 401k plans are required by law to vest their traditional matching contributions immediately, 100% on day one, zero waiting period. If your plan is a Safe Harbor plan, the vesting trap simply doesn't apply to the match. There's also a second type called a QECA Safe Harbor plan. That one is allowed to use up to a 2-year cliff, so it's better than the standard 3-year cliff, but not quite immediate. The catch is that you have to actually know which kind of plan you're in. Your summary plan description, the SPD, will tell you. Most people get it during onboarding, file it somewhere, and never look at it again. I'd pull it out now, or request a new copy from HR. I spend my days digging into the rules retirees actually have to live with, and the SPD is one of those documents that looks boring until it saves you or costs you real money. Look for the section labeled Vesting Schedule or Employer Contributions. Vesting. It will tell you exactly which schedule applies and how service is counted. Some plans count a year of service as 1,000 hours worked in a plan year, which affects part-time workers. Some use elapsed time. The specific language matters. Here's what the BLS data adds to this picture. The median tenure for workers ages 55 to 64 was 9.6 years as of January 2024, and 52% of workers ages 60 to 64 had been with their current employer for at least 10 years. What that means is that most older workers, just by staying put, naturally clear even the longest legally permitted vesting schedules. The vesting trap is almost entirely a late starter problem. Specifically, the person who has been chasing salary increases or running from bad employers in their 50s and hasn't had time to accumulate tenure. That person is the one who ends up in the Yale Law Journal's $1.50 billion forfeiture pool. My take on the job hop question is direct. If you're within 18 months of vesting on a meaningful match balance, don't leave. Negotiate the start date on the new offer. Ask the new employer whether they'll gross up your signing bonus to offset the forfeiture. Some will. Most people don't think to ask because they don't know the unvested balance is real money on the table. And if you're evaluating a new offer from scratch, ask HR on the first call whether the plan is a safe harbor plan. That one question tells you whether the match is immediately yours or whether there's a clock running. The catch-up rules in 2026 are genuinely powerful if you're in the right spot. A 62-year-old who can max the super catch-up is putting away $35,750 from their own paycheck, possibly with thousands more in employer match on top of that. The combined Section 415 ceiling of $72,000 gives employers room to be generous. But that generosity is conditional. The condition is time. And time is the one thing late starters are already short on. I'm not a licensed financial advisor. This is general education, not personalized advice. Consult a fiduciary before acting. If this raised questions about your own plan, the clearest next step is to pull your summary plan description and find the vesting schedule before your next career decision, not after. If you haven't subscribed yet, do that now so you don't miss what's coming next week, which is a topic that surprises almost every new retiree: Medicare's income-related premium surcharge and exactly where the $103,000 income threshold can hit you with a bill you didn't plan for. Drop a comment below with the retirement planning question you'd like me to dig into next. I read them and work the best ones into upcoming videos. And if you want a straightforward tool to track which vesting milestones you're approaching, I'll have a link in the description.